You are welcome back from the breakout session. We shall continue our discussion from here. And at this stage, we want to see the element of financial statements. What should we look out for in the financial statement? That's our focus at this stage. So first on the list is the assets. When we talk about assets, we are referring to resources controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. Meaning that any resources owned, managed, and controlled by a business as a result of past events, past undertaking, past activity, and that has the potential of generating future economic benefits to the entity, they are referred to as assets. So the assets can be in various forms or can be in various classes, but put them together, whatever resources that is owned, managed, directed, controlled by an entity as a result of its past involvement, and that has the potential of generating additional benefit, economic benefits to the entity, are referred collectively as an asset. So assets are classified into two. We have the non-current assets. Before now, the non-current assets used to be referred to as fixed assets. But we no longer address or call it as fixed assets. We now refer to it as non-current assets in line with the International Accounting Standard Board framework. So when we speak or talk about non-current assets, we mean the economic resources that aid income generation for more than one accounting period. If you look at the definition of asset as given earlier, we said the resources owned, controlled, managed by a business entity, managed by a corporation. But in the case of non-current assets, we are saying that these are resources that further assist in generating additional income or revenue for the organization for more than one accounting period. It means those assets are to be used for more than 12 calendar period. You know, in accounting, under the concept, we said there's a periodicity concept, meaning that accounting period should be subdivided normally into a period of 12 calendar months, making a year. So any asset that can be used by a business, that can be used by a corporation, that can be used by an entity for more than one accounting year, which is 12 months calendar, such an asset is referred to as non-current asset because it can be used over and over again, and while you are using it, it's generating further or additional income, it's generating additional revenue to the organization or to the business or an entity. So a very good example is land and building. You know, if you acquire a land, let's say in year 2020, that land can be there for in the next 10 years, it can be there in the next 20 years, it can be there forever, meaning that the land will continue to be useful. And why it's useful is serving the entity, is serving the owner, is bringing further returns, additional returns to the business entity. So because of its ability or the capacity to be used over and over again, particularly for more than accounting period of 12 calendar months, it is referred or regarded as non-current assets. So we can use it for as long as it lasted. Then we have motor vehicle as well. If a company has a fleet of car or say a motor vehicle, that vehicle can serve the organization for more than a year. The moment it can serve for more than one accounting period, it can be classified as non-current asset because it has the capacity to further generate additional economic benefit for the business. We have furniture and fittings, we have equipment, we have machinery, depending on the nature and the size of the business and the industry the business itself belongs to, that determines the kind of non-current assets so to be put in place. Then we have the current assets. Like I said, in the case of non-current assets, I told you we initially referred to them as fixed assets. However, we have stopped referring to them as fixed assets because of the position of IASB framework. So we now refer to them as non-current assets. So in the case of current assets, These are economic resources of business that can easily be converted to cash and can be consumed within an accounting period. If you look at these two definitions, it is clearly glaring that one has the capacity to serve the business for a very long time, while the other can only serve the business for just 12 calendar months or less. So any asset that does not have the lifespan beyond 1 year, 12 calendar months, to serve a business, such is classified as current asset. So they can easily be converted to cash. For instance, if we have, let's pick inventory as an example. Inventory is otherwise known as stock. We don't call it stock anymore. We refer to them as inventory. So if a company has an array of inventory, that inventory can be converted into cash, then it may be consumed within a year. That does not have the capacity to serve the company for so many years. So under the current asset, we are likely to see items like that. Then we have what we call prepayment. That is when somebody has paid but has not enjoyed the benefit for which the payment was made. We call such payment a prepayment. Of course, it is an asset, but the benefit has not been enjoyed by whoever has paid, by the customer. We classify that as part of current asset because it is related to that one accounting year end and not subsequent accounting year end. So by definition, liability is the opposite, direct opposite of what an asset is. So we describe a liability as a present obligation of an entity arising from past events and the settlement of which is expected to result in an outflow of resources that embodies economic benefits. So when assets are resources of an enterprise, obligations are commitments on the part of the business, commitment on the part of an entity, commitment on the part of a company. So they are current obligation, current commitment of an entity as a result of its past involvement or past activity. And in settling such, it will require that there is an outflow of resources from the organization. The difference between liability and asset is that asset brings additional economic benefits to the enterprise, whereas liability take out of the organization economic embodied benefits. It takes out, asset brings it brings in more or additional benefits, while liability take resources or benefits out of the enterprise. That's the difference between the two of them. As we have for assets, we equally have non-current liability, meaning that the commitment on part of the company that will take more than 1 year before repayment is due. That is, if a company is owing a supplier for, let's say, for 3 years or 5 years, that is far beyond 12 calendar months of 1 year. Such a liability will only be regarded as non-current liability because its repayment is beyond an accounting year end. I hope we are together. So if you relate this to non-current assets, the asset that has the capacity of serving the business, of serving the entity for more than 1 accounting year, they continue to aid income generation for more than a year. But in the case of non-current liability, it means the company will not be able to serve or repay all its liability or to meet all its commitments to the outside world, particularly the supplier, within an accounting period. So once it extends beyond a year, it becomes non-current liability. On the other hand, the liability that can be settled, that can be repaid, that can be offset within the accounting year, that is 12 calendar months, is known as current liability. It must be paid within the 12 months. We equally have equity. This is the residual interest in an entity after all its obligations or commitment or liability have been deducted from the value of all its assets. When a company is in place, of course, we try to make a distinction between the owner and the business. The owner, at times, they have some commitment into the organization. For instance, they might contribute capital into the organization. But what we are saying is that whatever belongs to that business At the end of the day, we are going to take away all his commitment, all his responsibility to third party, to outsider. We are going to take away all those liability from his resources, from the asset. Whatever is left is regarded or referred to as residual equity. If a company is able to settle all its liability from its assets and is having anything left behind, such is referred to as equity. So if you get a copy of financial statements, which I hope some of you must have seen one before now, these are elements, and these are some of the elements we're expected to see in a copy of financial statements. Not only that, you're expected to see the income, and let's take a look at what income is. Income is made up of revenue and gains. So revenue is the income arising in the course of ordinary activity of an entity. Businesses normally have their charts, they have an industry, they have the objective. So whatever income that emanates in the course of carrying out that objective or pursuing that objective is known as the ordinary activity. When a business does what is set up to do, whatever income it realizes, whatever revenue it realizes from doing so is referred to as income. Then there could be gains on disposal of non-current assets, which is a one-off event. It doesn't occur always. When I say one-off event, it means it rarely occurs, but not on regular or frequent basis. So there might be at times where a company might choose to sell off or to dispose some of its non-current assets, which I told you we normally refer to as fixed assets. When such disposal is made, whatever is realized from the sales is known as gains on disposal of non-current assets. This also constitutes income to the organization. So by the time we put the revenue from ordinary business activity plus the gain, we are talking about income available to the company. Then we have expenses. Expenses arising. This arises in the normal course of activity of an entity. What a company does regularly. Any expenses incurred while doing that it forms part of the expenses. Losses include loss on disposal of non-current assets or diminution in value of assets. When a company chooses to dispose or to sell off some of its non-current assets, and rather than making profit, which is known as gain, the company ended up sustaining losses, meaning it has lost some of its value. Put the two together, it makes what you know as expenses. So these elements, they are germane and they are quite vital in a copy of financial statement. So anytime you pick a copy of financial statement, you should be on the lookout for these few items or few elements of financial statement. And so when you are able to identify them, you have the understanding of what they represent. For instance, if you pick a copy, let's assume the financial statement, the statement of financial position is prepared using statement format. There will be a section for the assets where the assets are recorded. There will be a section for the liability. So under the section for the assets, you are able to identify the non-current assets. The moment you see them, you should be able to identify them, because these are assets that has capacity to serve the company for more than 1 year. The moment you see those that must be consumed within a year, you identify them as non-current liability. So obligation that must be settled within a year. So it's two-way. You have for assets, you equally have for the liability. So in summary, we are saying that for every financial statement, all these items are expected to be reflected and more. So like I told you, that we are likely not be able to cover all the course outline for the purpose of online teaching using LMS as put in place by the management. However, the little we are able to cover within the period of 6 weeks, we want to take it as soon as possible and to take it virtually. So the next topic is the control account. A control account is an account the balance of which reflects the aggregate balances of many related subsidiary accounts which are part of double entry system. The control account is a memorandum record only. As such, it does not form part of double entry system. I want to believe in the first semester you have been introduced to double entry principle as advocated by that Italian monk Luca Pacioli, who stated that for every debit entry there should be a corresponding credit entry, meaning that an item in financial statement should have two legs. You have the debit, you have the credit. However, in the case of control, it is not bothered about double entry. It only follows the principle of double entry in its recording, recording of transactions. But its own importance is that it shows at a glance the aggregate total balances of all related subsidiary accounts. For instance, let's say we have sales ledger control accounts. From that sales ledger control account, we should be able to see the total sales in entirety for an accounting period. That's the meaning of aggregate. It will show it. So all other sub records that make up what constitute the content, we have to be considered as well. So by the time you add them, you should be able to arrive at the aggregate figure reflected by the sales ledger control account. So all other sub accounts that you pull them together, cast their balances, it should be equivalent, or it should be equal to the amount as reflected on the sales ledger control account. We have sales ledger control account. Equally, we have the purchases ledger control account. But what is paramount is that this account is useful in the following area. One, it facilitates early detection of error. As human beings, we are bound to make mistakes because sometimes while carrying out our duty as an accountant, there is possibility of making a mistake. There's possibility of committing error. There's possibility of doing things the wrong way. When this happens, the control account enables an accountant to easily trace and detect the error. You go through the record that has been put together, go through the figures that have been captured, and you'll be able to identify or detect any error that might have been captured along with the recording. Then fraud perpetration is equally minimal. When there is control account in place, the chances of perpetrating fraud, the chances of defrauding or taking advantage of what does not belong to one in an organization will be reduced, because control account is usually put under the care of a supervisor, particularly people with impeccable characters. So we believe that having such accounts on ground, it will assist the organization to have its exposure to fraud minimized. Then it equally provides information about total trade receivables and total trade payable. Like I said, when we talk about trade receivable, we are talking about sales. We are talking about sales, goods sold to customer. The customer might have paid, they might not have paid. However, what is germane is that in control account, cash sales or cash purchases do not come up. They are not reflected in control account. Rather, they should be taken care of in the cash book. I believe you have an idea of what a cash book is. Single column cash book, double column cash book, and the rest. So when we talk about trade receivable, we are talking about sales, particularly credit sales. And when we say trade payable, we are talking about credit purchases. So this control account, it gives us information about the total trade receivable. For an accounting year end, we can have at a glance the total sales, the balance on the sales ledger control account. We can equally have at a glance the balance on the purchases ledger control account. And so when that is possible, managing the record will be seamless. It makes it easy to manage. It equally accounts for account, it allows for account setup. Yeah, it also reduces delay in preparation of financial accounts. When the control account is in place, the delay that normally the delay that comes with preparation of final accounts situation whereby the account is not available as at when required, that delay will no longer be there, because we can pick the figure, we can pick the total figure from those from those receivable or ledger control accounts, either for sales or for purchases. Even if it's for high expenses, we can easily pick them. And so by having access to them readily available, it will eliminate the delay normally experienced at the time of preparing financial account. So information that goes into control account could come from receivables and payables account. When we talk about receivable, I said it means sales, and when we talk about payable, it means purchases. Then it can come from return inwards or outwards account. What do we mean by return inward? When goods are sold to a customer, it is possible after a while that the customer returns part of the goods for different reasons. So when that happens, it is those items, the return item is taken under return inward. And it is equally possible for a business to purchase certain items or goods from outside and have the cost to return some. When it happens, we call that or refer to it as return outward. Then there's bill payable as well as bills receivable. We have the dishonored check issued to a customer but was not honored by bank. Information from there equally goes to control account. Then we have cash paid to supplier. That's payable. When we purchase goods on credit, of course we are expected to pay at an agreed or a later date. So anytime we make such payments to the supplier, it is expected to go and reduce our indebtedness to, before that supplier. For instance, we are owing somebody 200,000 and we issue a check of 120,000. It means our debt is no longer 200,000, rather it is 80,000, because the check we have issued in settling the supplier, that value of 120,000 should be taken care. It should be taken away from our total debt of 200,000, meaning that our outstanding liability will be 80,000. Then cash received from customers. Somebody we have sold goods to on credit. If such person chooses to pay, then we set it off against his own indebtedness with the company, so the balance will be reduced, or at most cases it can be settled at once. Then we have discounts received as well as discount allowed, meaning that when you buy goods in large in bulk, when you buy in bulk or in large quantity, you stand the chance of enjoying certain discount. You may be granted some discount. Also, when somebody purchases from your business, from your company, purchasing in large quantity, such might attract you, granting such a person certain discount. But as we progress, we are going to see the discount in its various forms. We will look at the trade discount, we look at the cash discount, and what have you. Then from our sales day book and purchase day book, we can always have information that are useful for the preparation of control accounts. And so if time still permits us, we'll still take some example illustrations to illustrate this topic before we proceed to other topic of discussion, provided the time is on our side. So on this note, I want to thank you again and to announce to you the breakout section. This is the second part or second version of the presentation, and so at this breakout section you're expected to go over what we have discussed, see the area of understanding or where there's need for more explanation, show your understanding of all we have discussed, and have the rest of the day to yourself. Once again, I want to appreciate you for being attentive in class, and I hope to see you, aside from these virtual classes, I hope to see you physically when you come on campus. Until then, stay fit. Thank you.